Hey, what's up, you guys? In this video, I'm going to try my best to, as simply and concisely, explain what options are and how they work. It's a lot of information, so I don't expect you guys to understand everything right away. It's kind of one of those things where you need to practice it to really get it. However, on this channel, Monday through Friday, I'll be completely disclosing my options account, how much I'm up, how much I'm down, what options I purchased or sold, so you guys can see options trading in practice. If that's something that interests you, go ahead and please subscribe to the channel so you can follow me along on this journey. Without further ado, let's get into the video. So, what is an options contract? Very simply put, an options contract is a thing that goes up in value or down in value based on if the stock that it's tied to goes up in value or down in value. There is a more formal definition that involves telling you have the right to buy 100 shares at the strike price by the expiration, blah, blah, blah. We don't want to worry about that. We want to keep things very simple. So again, it's a thingy that goes up or down in value based on if the stock that it's tied to goes up or down in value. Okay. Options are divided into two categories. Over here in green, you have your calls, and over here in red, you have your puts. For the calls, if the stock that your contract is tied to goes up, then you're happy. For the puts, it's the opposite. If the stock that your contract is tied to goes down, then you're happy. So here in yellow, we have some definitions that you guys need to know, starting with the strike price. So the strike price is the minimum price that the stock your contract is tied to needs to be above in order for your contract to not be worth $0 at the expiration date. So if the expiration date comes around and your stock is worth less than the strike price, your options contract is worth $0. Now, if the expiration date comes around and your stock is equal to the strike price, then your contract is also worth $0. And the strike price will be given to you at purchase. Next, we have break even. So break even is the price that your stock needs to be at come expiration date in order for your contract to break even. If it's above the break-even price, if your stock is above the break-even price, then you'll be making profit. If it's at the break-even price come expiration, you'll be right at break-even. So, hence the break-even name. This is also given to you right at purchase. It tells you your strike price and it tells you your break-even price. Next, we have the expiration date. This is very self-explanatory. This is basically just when the contract expires. Once the expiration date rolls around, whatever the value of your contract is, that's what you get. There are other things involved with expiration that have to do with Theta. We'll talk about that when we get to Theta. Next, we have in the money and out of the money contracts. So this is a big part of options trading. They're divided into calls and puts, and then they're further divided into in the money or out of the money. I'm going to break this down for you. This is very important. So when your contract is in the money, that means that the strike price of your contract is lower than the current price of the stock. So for example, if you're trying to buy an options contract on Apple and Apple's trading at $100 and your strike price is at $95, your strike price is lower than what Apple is trading at. And this comes with a few perks, one of them being a lower strike price. And remember, the strike price is the minimum price that the stock has to be in order for it to be worthless. So you want this to be as low as possible. For example, if you had a strike price on Apple of $50, in order for your contract to become worthless, Apple would have to fall all the way down to $50 by the expiration date. Don't forget about the expiration date. The second perk is it has a lower break even. So remember, the break even is the minimum price that your contract has to be at, or that the stock that your contract is tied to has to be at by the expiration date in order for you to break even. And anything above that is profit for you. So let's say you had a break even price on Apple at $105. Then all Apple would have to do is by the expiration date go up $5 for you to secure your break even, and anything above $105 for Apple would be profit for you. And then lastly, it has a higher delta. Again, when we get to delta, I'll come back and touch up on that. Now, for these three perks, you will be paying a higher price. In the money options are a lot more expensive than out of the money options. but it makes sense because you get 3 perks for them. On the flip side, you have out of the money options. This is the complete opposite. It's when the strike price is higher than what the current stock price is, which means that Apple would have to go $5.01 higher in order to get above your strike price and prevent your contract from becoming worthless. Whereas if we take a look over here at in the money, Apple has the ability to fall $4.99 and still be above your strike price, still have some type of value. Another negative for out of the money call options is a higher break even. This basically means that Apple will have to go up a whole bunch more just for you to break even on your contract by the expiration date. So you can imagine if your break even is at $150, let's say with an expiration of 2 weeks, you're basically saying in 2 weeks you believe Apple will be at $150 just for you to break even on your contract, and anything below that you'll lose money on your contract. Now this is a good time for me to pause and let you guys know that before the expiration date actually arrives, anything can happen. Apple could spike up $25 one day, and that will in turn increase the value of your contract, so that even though by the time your expiration date comes around, Apple won't be at $150, for the time being, the price of Apple did go up, which means the price of your contract did go up, and you can sell the contract before the expiration date for a profit. Now, this is what most people do. This is how it actually works. However, using that as a strategy is extremely risky, and when we find out a bit more about a few of the other ones over here, you guys will see why. So another negative of the out of the money calls is a lower delta. And don't worry, delta is right over here. We'll get to that in a second. But for these 3 downfalls, what is the perk for out of the money calls? Well, they're very, very cheap. And this is what most people do. Most people do not have the money to buy the more expensive in the money calls because, let's be real, they're pretty dang expensive. So they buy the cheaper out of the money calls instead because they don't really realize exactly how bad these 3 negatives are. Like, these 3 negatives are 3 really big negatives. You don't see successful options traders buying out of the money calls too often. So let's keep moving on. You have cost. Now, this is actually something important to note. Very simple, but important to note. So when you're dealing with options, they have the price of everything is actually should be multiplied by 100. So they'll show you $10, but you have to multiply by that by 100 to get $1,000. That's what you're actually paying. So if they show you that a contract is worth $10, it basically means the contract is worth $1,000. If they show you that the contract is worth $4.65, the contract is actually worth $465. You have to multiply by 100 because they're actually pricing in each individual share of the contract, and each contract gives you the right to sell or buy 100 shares. It goes back to the formal explanation of what an options contract is. You don't have to worry about that. Just know that whatever price you see, multiply that by 100 to get the actual price. Now you have the bid ask. Bid ask is another important aspect to options. So the bid is the price that someone wants to buy the contract for, and the ask is the price that someone wants to sell it for. So when you're dealing with contracts, you want for the bid-ask spread to be as tight as possible because that represents volume, represents a lot of people trying to buy and sell that same contract. And when that happens, it's indicative of liquidity. Liquidity basically means that when you want to get out of the contract, boom, you can get out as soon as you want to get out. When there isn't liquidity and the bid-ask spread is really large, sometimes you would want to get out of your contract and you won't be able to. And you never want to be in a situation like that. You want to be able to get out of the contract as soon as you want to. So here's some examples. The bid, $7.30, which is actually $730, multiplied by 100. The ask, $9.25. That's a difference of $1.95. That is bad. Okay, you don't want that. $6.15 for the bid, $6.85 for the ask, a difference of 60 cents. That's okay. What you really want though, $4.30 for the bid, $4.40 for the ask. It's a difference of 10 cents. That is good. That means that there's a lot of volume. There's a lot of people that want to buy and sell that specific contract, and you'll be able to get in and out of the position instantly. The more expensive the contracts, however, the larger the difference can be. And this makes sense. Just think about it like this. If you want to sell a car for $1 million and somebody wants to buy the car for $990,000, the difference is $10,000, which is a lot, but respective to the price that you guys are asking for, it's not a lot. So finally, let's get to the big boys. These are referred to as the Greeks. Now, there are more than 2 Greeks, but these are the main 2 that I want to get into because, again, I'm trying to keep this simple. As I was filming this video, I've noticed how hard it is to keep some of this stuff simple. And I did say it was a lot of information, and it is a lot of information. So again, something you have to practice before you can actually really understand how this thing works. But delta. So delta is the change in value of your contract based on the movement of the stock it's tied to. So if the stock that your contract is tied to goes up $1, your contract, for example, will go up $60. And the more in the money, the higher the delta. As you can see over here, in the money has a higher delta. This is actually another mistake a lot of people who don't really understand options make. They think that it's a 1-to-1 ratio. So if let's go back to the Apple situation. They think that if Apple goes to $101, that their contract will go up $100. That's not the case. It is possible to get a contract that goes close to 1-to-1. That would be the farthest in the money contract you could buy, which would also be the most expensive contract that you could buy. And I should note that when I say 1-to-1, I really mean 1 to 100. For every dollar that the stock moves, your contract will go up $100. They say 1-to-1 because it's $1 for each share that your contract controls, which is again 100. But what I really mean is 1 to 100. So let's get to theta. Theta is the amount of value that your contract loses every day until expiration. This is actually another Greek that people tend to forget about. They don't really take this into consideration. The closer that your contract is to expiration, the higher the theta will be. So if you have a theta of 0.174, and theta, just like the cost, you have to multiply that by 100. So you just move the decimal place over 2 spots. That means that your contract will go down $17.40 per day, and theta increases every day that you get closer to your expiration. So you could think of theta as the price you pay for owning the contract. And the closer you get to expiration, the longer you've been holding the contract, the more you'll be charged for the theta. So the farther out from expiration, the lower the theta. That's why it's good to buy very long-term contracts. The theta is very, very small. Instead of paying something like $17 per day, you'll probably pay less than $1 a day for the contract. So that's theta. And last but not least, we have the 3 factors that affect the value of your contract. So let's get into these 3 factors. The first one is the simplest one. It's the one everyone knows about. It's just the price action of the underlying stock. And that's what I've been referring to as the stock that your contract is tied to. They refer to it as the underlying stock. So if the underlying stock goes up, then the price of your contract goes up. And now this is for calls. I didn't mention puts because puts are very similar to calls. It's just the exact opposite. But in regards to calls, if the value of the stock that the contract is tied to goes up, the value of your stock goes up. If the price goes down, then the value of your stock goes down. That's one of the factors that affect the value of your stock. The second factor is time decay. A lot of people know about this, but like I mentioned earlier, they don't really take it into account. Time decay is expressed in theta. Theta is basically what time decay is, and it's the value, it's the amount of money you pay each day you hold the contract. That's the second way that your contract can be affected. And then the third one is the one that people really forget about when it comes to contracts. That is implied volatility. So implied volatility is a function of the price movement of the underlying stock. I don't know what the algorithm is that calculates it, but it's just a reflection of the volatility within that stock. So if you have a $10 stock and intraday it moves from $10 to $12, that's a 20% difference. That's a pretty high difference. That would be considered a volatile stock, which means the implied volatility would be very high. And implied volatility, the higher it is, the more expensive the stock is. Because when you have a stock that's really volatile, it's easier for it to, at any given point between the time you buy it and its expiration date, for it to jump into the money above your break-even price and give you a profit. For stocks that are less volatile, it's less likely that they'll have some random spike that'll send your contract into profit. So the higher the implied volatility is, the more expensive the contract. But at the same time, if the implied volatility goes down, the value of your contract will also decrease. So if you have a stock that goes from $10 to $12 movement in a day, it's a 20% movement, to a stock that then goes from $10.25 to $10.50, and that's all it moves that day, that's only 2.4% movement. Implied volatility as a result will fall, and subsequently the value of your contract will fall. So these, my friends, are the three factors that go into calculating the value of your contract. Now here's the thing. There's three factors, right? At the most, at the very best, 2 out of the 3 are on your side. 2 out of the 3 are positives for you. At the worst, all 3 of them can be negative for you. So the 2 that are positive for you could be the price action and the implied volatility. The price of the stock goes up, and it goes up a lot. That'll increase implied volatility. That'll increase the price of the stock. Both of those will help to increase your the value of your contract. Time decay will never be on your side. Time decay is just the price you pay for the contract. The contract will never pay you for owning it. You will always pay the contract. So time decay will never be on your side. On the opposite end, though, all 3 of these can go against you. So if the stock goes down, the value of your contract will go down. If implied volatility goes down, which means your contract goes from the underlying stock goes from moving a whole bunch to moving only a little bit, that will hurt you. And if you are holding on to the contract, it will obviously hurt you, especially the closer to the expiration date you are. So all 3 of these are capable of going against you. So you have to understand that when it comes to contracts, you're always at a disadvantage. But if you do it right, you can, most of the time, make more money than what you lose. The key is controlling these 3 factors to the best of your ability. So how do you control implied volatility? Don't get into super volatile stocks that can drop 50% in a week. Pretty simple. Time decay, make the expiration date on the contract as far out as you can. This one is probably the hardest one to control because it has to do a lot with pricing. The farther out the expiration, the more it's going to cost you. And a lot of people don't have the money to be buying such expensive contracts. So that one is understandable. That one's one where you kind of have to find a balance. But then the third one, how do you control price action? It's not easy to control price action, but the only way you can indirectly control price action is by choosing good stocks. Good companies, good stocks tend to go up over time. Bad companies tend to go down over time. Don't get into these penny stocks. Don't get into these very speculative stocks. Get into good, solid stocks that will go up over time for you. Okay. So, again, guys, this was a lot of information. It's a very long video, but I hope a lot of the information here is useful to you. This is basically the whole general breakdown of what options are and how they work. again, you need to try them out on your own. It's one of those things where you have to invest money and time and probably lose a lot of money before you can kind of get the hang of it. But that's also why I started this channel. I've been trading options for quite some time now, and I feel like I've gotten the hang of it. I've made a lot of money from them. And again, I will fully disclose all my trades to you guys so you guys can get a sense of what it is to trade options before you get into it yourself, not knowing what you're really doing, and lose a lot of money. So that's it for this video. If you guys found this useful, if you think I did a good job, please leave a like down below. And if you feel like the daily uploads of my account and disclosing all of my trades to you is something you're interested in doing, interested in watching, then please subscribe. Subscribe to the channel. It's a newer channel. I'm trying to build it up, and I would really appreciate that. So I'll see you guys tomorrow with an update on the market, and that's it for this one, guys. Peace.